On June 5th, 2026, in one single trading session, an unbelievable $1.3 trillion suddenly vanished from chip stocks. Look at the Philadelphia Semiconductor Index, the best gauge we have for the chip industry. Nvidia, AMD, and Micron all plummeted, dragging the index into a steep cliff. It collapsed 10.3%, its worst day since March 2020. Typically, a wipeout of this magnitude signals a dying industry or a complete corporate failure, the kind of event preceded by terrible sales and massive internal debt. But look at Nvidia's actual data for that exact same period. They reported $68 billion in Q4 revenue. That's a 73% year-over-year increase. They are a $5 trillion company breaking their own sales records. Despite beating expectations, $300 billion of Nvidia's market cap disappeared in a single afternoon. To survive the AI boom, investors must learn the difference between a structurally broken business and a broken market expectation. When the markets opened on the morning of the crash, two immediate catalysts hit the wire at the exact same time. First, Broadcom released a weak earnings report. In the chip world, Broadcom acts as the canary in the coal mine. When they miss their targets, the whole sector takes a hit. Seconds later, a red-hot jobs report appeared. Stronger than expected employment numbers signaled that the Federal Reserve would likely hike interest rates again. Higher interest rates make borrowing expensive, forcing investors to pull money out of high-growth tech stocks, crushing their valuations. Wall Street's baseline expectations for AI growth were set so impossibly high that even Nvidia's record-breaking quarter felt like a disappointment. This crash emerged from the collision of bad macroeconomic timing and mathematically impossible expectations. But the jobs data and the Broadcom miss were just the spark. Two long-term anxieties are driving the deeper sell-off. The first is the return on investment. Tech giants are pouring hundreds of billions of dollars into data centers, and investors are questioning if they will actually make that money back. The second fear comes from companies like DeepSeek, who proved that powerful AI models can run on significantly less computing power than previously thought. This is a direct threat to Nvidia's bottom line. If AI software continues getting more efficient, the market's need for an endless supply of $40,000 GPUs starts to dry up. Unproven returns combined with more efficient software alternatives create a significant threat to long-term hardware valuations. The AI industry is entering a phase of maturity. The emotional market reaction often hides the structural reality. Institutional belief remains high. At the end of the last quarter, 264 of the world's top hedge funds held their Nvidia positions right through the volatility. The hardware pipeline also remains intact. Nvidia is already preparing for the launch of their next-generation Vera Rubin processors, showing that physical production hasn't slowed. Managing a portfolio in this sector requires specific strategic shifts. The first priority is volatility management. 5% daily price swings are a built-in feature of high-growth tech. Position sizing must be conservative enough to prevent panic selling during these swings. Investors also need to diversify across the entire hardware ecosystem, rather than betting exclusively on a single ticker. This node map shows a safer strategy. By spreading exposure, you can hold AMD for competition, Micron for memory chips, and TSMC for manufacturing. Finally, keep a close watch on Broadcom. Their upcoming earnings reports act as an early warning system for the entire AI hardware space. June 5th functioned as a standard market correction, leaving the core AI growth story intact. In the next episode, I'll break down exactly which stocks to buy in the aftermath of the crash.